Hi, this is Ross Healy, the Chairman of Strategic Analysis Corporation and Portfolio Manager for McNichol & Associates Asset Management, welcoming you back to FANG Friday. Well, today I'm going to sort of take a look at some of these FANG stocks a little more close and personal, and we're going to start off with Amazon, which, as you can see, has had a sort of a nice little run the past 3 days. But also notice, however, that it has pretty much kind of stayed within a fairly tight channel there, and this is over the last 3 months. For the past 6 months here, it is quite clear that the stock has broken below its HB3 and I think very much wants to drop down to its HB2. That's 16 times book down to 12 times book. From a long-term point of view, or longer-term point of view, it is quite clear that that HB3 channel has firmly let go. And from an even longer point of view, looking at the 2 years, you can see that the stock has already had a 2 breakpoint fall, has rallied along the HB3 price, and looks like we may be heading for another 1 or maybe 2 breakpoints. Of course, from a very long point of view, which I find quite interesting here, for a long time the stock actually remained within this nice channel of HB3, HB4. Had a little kind of walk on the wild side, as it were, when it broke out here, tried to get to the HB5, failed, but now it looks as if it is heading lower now on a somewhat permanent basis. Looking at Amazon from an even longer point of view, a 10-year point of view, you can see why when the stock got way up to these very rarefied levels that we became increasingly skeptical that the stock could stay there. See, here's the ROE on Amazon, and the implied ROE today is about 21%. Well, does that justify a price to book of more than 14 times and a price earnings ratio of 68 times? I'm not sure that it does, and I think that that's the reason why this stock is losing altitude. Turning to Facebook now, what we see here is a picture of the company just sort of hanging on either side of its mid-super growth price. That's 5.5 times book value. Now, that actually, if it can continue to do this, is not actually all that bad, because if you look 6 months ago at the price of the MSG price of the stock, it was 177. 6 months later, it's 197. So that is an implied growth rate of the balance sheet of 22%. Well, if the company can hang on here, 22% these days, not bad. It beats the long-term bond rate in the States of 1 3/4. Looking at Alphabet, by the way, whose implied ROE is 17.6%, and therefore deserves of a lower valuation than Facebook. Alphabet just came back up to its low super growth price. That's 4.5 times book value. Just came up there, has not been able to break out, and that's not terribly surprising because you can see here that the earnings estimates and therefore the implied fair market value of the company has actually been oozing very slightly downwards. Well, here's Netflix, and what we thought may be a false breakout has indeed transpired into something perhaps more lasting. It's difficult to actually understand the rationale of investors with all of the new competition that's coming into the streaming business, but it seems to be kind of following the Disney stock valuation in rising. So we'll have to give this one a breakout and a potential of 372 on the market. Wow. This is the kind of thing that would make me very, very nervous. Anyway, it's now followed our 3% 5-day rule, and therefore we have to say, okay, you're out. Let's hope for the best. NVIDIA, well, we had two what we call false breakouts, check back, false breakout, check back, and we thought, well, we've got another one. Turned out not to be the case. And it looks as if it is moving higher towards its HB2, that is 12 times its book value. Anyway, you can see on the longer term view of the company after that big break from 275 down to 149, lost half of its value. That the stock has been now trading between its bubble price, that's 7.4 times book value, and its HB2 price, which is 12 times book value. Maybe it'll get there again. I see that the analysts, after being quite negative on the earnings outlook, have turned positive again, and so the earnings estimates and therefore the fair market value are rising. The stock, I may say, still has, from our point of view, a 47% downside potential in it based on its intrinsic value. However, Apple, well, Apple, I would say it, in a sense, it continues to defy the gravity of the past 10 years. You can see here, looking at the fair market value, which is this dotted line on the chart, that had very, very nicely contained the price of the stock for all but, just the last few months. Part of the reason for that, however, is the fact that the company has been buying back stock. And the act of buying back stock, of course, what that does, as we will see, raises the ROE of the company. And it is this rise in the ROE of the company beyond what it has been for the past 10 years appears to be propelling the company higher. It may well get to that HB2 price if it continues to buy back stock at the rate that it has. Finally, here is Microsoft. And look up for the past 6 months, this company has been just oozing along its HB1 price. That's 10 times book value. And very, very lately, the stock has been breaking out. Well, if you're very bullish on the market and you like the outlook for this company, and you can see there's been an uptick here a little bit faster for the earnings forecasts and therefore the intrinsic value of the company, you can go with it. After all, if you're wrong, don't forget that if it pulls back to and below its HB1, that is an automatic sell signal for this stock. So you probably are not risking all that much by purchasing the stock at this particular level. Let me take a much longer viewpoint, however, and we'll see whether we think that this breakout is justified, and therefore how much caution you should be exerting if you should elect to buy the stock here. So here's a look at Microsoft and its ROE going back for a full 10 years. And of course, then here's the price to book. And the price to book has been rising beautifully up to 10 times that value. But nothing much has happened to the ROE of the company, which stands at about 36%. Well, 36% ROE and 27 times earnings at 10 times book value does not make for a particularly cheap stock. And that's what the intrinsic value is telling you, which is 38% below the current price. So the stock looks like it's breaking out, perhaps, but we would have to say we are from Missouri on this one. Buy it if you will, but remember to use a stop loss. Anyway, this has been Ross Healy for Strategic Analysis Corporation and the portfolio manager for McNichol & Associates. Just, by the way, a quick reminder, on Wednesday at 12 o'clock I shall be on BNN to do a full hour with Andy Bell. So perhaps I will see you then. Anyway, just to remind you that nothing, including investing, is difficult if you have the right tools. I'll see you Wednesday. Bye for now.